Welcome to our channel where we decode complex financial concepts for you. Today, we're diving into the world of risk management trading. Risk management, in the world of trading, is a bit like driving a car. You wouldn't just get behind the wheel without a seatbelt, would you? Or drive without checking your mirrors. Similarly, trading without risk management is like navigating the financial markets blindfolded and without a safety harness. It's an essential part of the trading journey, a compass guiding traders through the tumultuous seas of market volatility. It's not about avoiding risk altogether because, let's be honest, trading is inherently risky. It's about understanding, measuring, and managing that risk effectively. And that, dear listeners, is the art and science of risk management trading. For the novice traders out there, think of risk management as your trading safety net. It can help protect your capital from significant losses, ensuring you live to trade another day. And for the seasoned traders, well, you know the drill. Risk management is what can differentiate a profitable trader from a losing one. It's a game of strategy, patience, and resilience. Over the next few minutes, we'll unmask this seemingly complex concept, breaking it down into bite-sized, digestible pieces. We'll delve into the fundamental principles of risk management in trading, explore various strategies, and walk you through how to effectively implement these into your trading routine. Whether you're a newbie just dipping your toes into the trading pool or a veteran trader looking to fine-tune your risk management skills, this journey is for you. We'll navigate through the twists and turns of the financial markets, shedding light on how to keep your trading ship steady, even in the roughest of seas. But remember, risk management isn't a one-size-fits-all approach. It's a personalized strategy that adjusts with your trading style, market conditions, and financial goals. It's about finding your balance, your rhythm in the chaotic trading dance. So, buckle up and let's embark on this enlightening journey together. Stay with us to uncover the secrets of successful risk management in trading. Risk management trading might sound daunting, but it's really about understanding and controlling your exposure to potential losses. Let's break it down to the basics. First off, every trade involves a certain level of risk and reward. The risk-reward ratio, as it's called, is a crucial concept in trading. Simply put, it's the potential profit you expect from a trade compared to what you could potentially lose. For instance, if you're aiming to earn $100 but could lose $50, your risk-reward ratio is 2 to 1. In an ideal world, you'd want your potential reward to always be higher than your risk. Secondly, let's talk about stop-loss orders. These are your safety nets in trading. By setting a stop-loss order, you're instructing your broker to sell a security when it reaches a certain price. This way, you can limit your loss on a security's position. Imagine you've bought a stock at $60 per share. You could set a stop-loss order at $55, meaning if the stock dips to that price, it's automatically sold, preventing further loss. Lastly, we have diversification. You've probably heard the saying, don't put all your eggs in one basket. That's the essence of diversification. Spreading your investments across various financial instruments, sectors, or industries. This strategy helps to reduce the risk of catastrophic losses because the negative performance of some investments will likely be offset by the positive performance of others. Remember, trading isn't about making a quick buck. It's about managing risk, making informed decisions, and maintaining a balanced portfolio. It's about not letting the winds of the market blow you off course, but learning to adjust your sails to reach your financial destination. Now that we've covered the basics, let's delve deeper into some strategies. Effective risk management strategies can be the difference between a profitable trader and one that's constantly on edge. Risk management involves more than just understanding the ebb and flow of the market. It's about employing strategic measures to safeguard your investments. Let's delve into a few of these strategies. First up, we have position sizing. This is essentially the part of your portfolio you're willing to risk on a single trade. For example, let's say you're a cautious investor. You might risk just 1% of your portfolio on a single trade. This way, even if the trade doesn't pan out, the impact on your overall portfolio is minimal. Next, consider hedging. This is akin to buying insurance for your trades. Imagine you've invested in a company that relies heavily on oil. If oil prices rise, your investment might suffer. To hedge against this risk, you could invest in an oil futures contract, which would increase in value if oil prices rise. That way, losses from your initial investment could be offset by gains from your hedge. Lastly, let's talk about using derivatives. Derivatives, like options and futures, can be used to manage risk. For instance, purchasing a put option gives you the right to sell a stock at a predetermined price. If the stock's price plummets, your put option increases in value, helping to mitigate your losses. Let's bring these strategies to life with a real-world example. Imagine you're a farmer who grows apples. To protect against the risk of apple prices dropping, you could sell a futures contract. This guarantees you a set price for your apples, regardless of market fluctuations. That's risk management in action. Remember, these strategies are not one-size-fits-all. They must be tailored to your specific risk tolerance, investment goals, and market outlook. And like any tool, they're only effective if used correctly. These strategies are merely tools in your trading toolbox. Let's look at how you can put these tools to work. Implementing risk management strategies into your trading routine requires discipline and consistency. It's like integrating a fitness regime into your daily routine. You can't expect results overnight, and consistency is key. Let's start with setting trading goals. Your goals should be smart, specific, measurable, achievable, relevant, and time-bound. For instance, instead of setting a vague goal like "I want to make money," you might say, "I aim to achieve a 10% return on my investment in the next 6 months." Setting clear, measurable goals allows you to track your progress and adjust your strategy when necessary. Next, let's discuss the importance of keeping a trading journal. This is where you record your trades, the rationale behind them, and their outcomes. It's like keeping a diary of your trading journey. This journal can provide valuable insights into your trading habits, helping you identify patterns, strengths, and areas for improvement. Moreover, regularly reviewing your trading performance is another critical aspect of risk management. This isn't about obsessing over every win or loss. Rather, it's about stepping back, looking at the bigger picture, and evaluating your overall performance. Ask yourself, are you meeting your trading goals? Are you sticking to your risk management strategy? What can you do better? Remember, the financial markets are always evolving, and so should your trading strategy. Regularly reviewing and adjusting your strategy based on market trends and personal performance is a key part of effective risk management. Finally, don't forget to maintain a healthy balance between risk and reward. It's easy to get carried away by the prospect of high returns and forget about the potential risks. Always keep in mind that high reward comes with high risk. Therefore, ensure that the potential reward of a trade is worth the risk you're taking. Risk management is not a one-time task, but an ongoing process. Let's wrap up what we've learned. We've covered a lot today, from the basics of risk management trading to how to implement it into your trading routine. Let's take a moment to revisit these key points, shall we? We began by exploring the concept of risk management in trading, a key pillar in the world of finance. Remember, it's not just about avoiding risk, but understanding and managing it. It's about making informed decisions even when the market seems unpredictable. We then delved into the heart of risk management strategies. From setting stop-loss orders to diversifying your portfolio, these strategies are designed to help you navigate the choppy waters of trading. They're not foolproof, but they can significantly reduce your potential losses. However, it's one thing to know about these strategies and another to implement them effectively. We guided you through the process of incorporating risk management into your trading routine. Whether you're a veteran trader or a novice, these strategies can be tailored to your specific needs and risk tolerance. Now, it's important to address some common misconceptions about risk management trading. It's not a guaranteed ticket to success, nor is it a one-size-fits-all solution. It's a tool, and like any tool, its effectiveness depends on how well you use it. Don't fall into the trap of complacency. Stay vigilant, stay informed, and remember that even the best-laid plans can go awry. Managing risks in trading isn't just about preserving your capital, it's also about seizing opportunities. It's about striking a balance between caution and ambition, between fear and greed. It's about transforming uncertainty into a game of skill, not just a game of chance. Remember, successful trading isn't just about making profits, but also about managing risks. Please subscribe, like, share, and hit the notification bell to stay updated with our latest financial insights. Now, we'd love to hear from you. Which risk management strategy will you be implementing first? Let us know in the comments below.